What's up?
Oh, there you are. I was like, please tell me you can hear me. So this one's going to be fun. There's some
Yeah.
fun stuff that happened over the weekend.
It's been a fun weekend for
It has.
the financial
And it's
services
supposed to get
industry.
cold tonight. So
Yeah, below
apparently
freezing.
that's crazy. I just put all my plants out. So now I got to bring them all back in. Anyway, all right. Industry update. Let's start with just some numbers, and then I want to save a lot of time for this SVP bank conversation, but let's start with these numbers. Obviously, February numbers came in. If you're on the realestatestats.com, you can see February came in at about 42% less than February the year before. That's not actually an accurate statistic, and let me tell you why. Because agents don't close their transactions out in the MLS, Mark.
That's true. That is true.
When they don't close it out, we can't pull the accurate numbers. And then all of a sudden, like 2 months later, the number changes.
Yeah.
So it's probably around 35%. So give or take, if I'm generalizing, which I don't like to generalize in statistics, but if we're generalizing, the market's about 30 to 35% down than where it was last year. Would you add any commentary to that?
No, I think that's dead on.
Yeah.
That's what I'm saying.
But prices are still up, which is good. Interest rates are coming down. We're going to talk about that in terms of this bank collapse. Days on market are kind of in a little over 1 month range, which, I mean, if anybody's telling me that's long, we need to have a different conversation. But,
right. Yeah.
It's certainly changed from a year ago.
Right.
But that's not long.
We're just not in the COVID world anymore. So pandemic, real estate market no longer exists, and we're back to a semblance of reality. Yeah.
And I mean, look, we were 28 days on market at February. You go back to 2019, end of the year, they were coming in at 36 days on market. It's pretty normal. I'll use the term velocity in the marketplace right now. Any comments on that?
No, I mean, when I got in the market, I mean, I just got my license in 1999 and it was a strong market, but by 2003, 2004, things took sometimes 3 or 4 months to sell. So, 28 days overall is not a bad amount of time.
Yep. So anyway, I don't want to spend too much on this. Anybody can jump on this. Your team leader's got your secret passcode if you want to jump in. But therealestatestats.com. I'm going to jump over the counties. I'm sorry, the counties. So Fulton County, Mark, we got 606 active listing, a little bit down from last week, but certainly up from previous weeks.
Yep.
So there's some good inventory out there to sell. Active under contract is at 144. We're climbing. We're in the spring market right now. 299 pending.
Yep, the
I'm loving that.
Definitely is trending up. If you look at January, where we were in January to February to March, it's steadily increasing.
Yeah, I mean, look at that. 90, 100, 115, 125. Now we're up to 144. That's a velocity number too. It's the number of houses going under contract. Right. Pending's the same story, Mark. I mean, if you go back to the beginning of the year, 83, 150, 190, 250, and now we're up to 299, right? Yep. So we could do the same exercise with closings. So at the beginning of the year, 147 in closings, 268, 134, 154, 170. And then we get over here and we're 261.
Right.
So these are some pretty healthy spring market bell curve kind of numbers, right?
Yeah, we're feeling it in the market centers for sure.
Yeah. All right. So DeKalb County, same kind of story. 362 on the active listing front, 98 on the under contract. Oh, my cursor. We were 104 at the end of last month. So 98's a good, healthy number. It certainly was more than we had in any 7-day total in the month of February.
Right.
193 pending, 174 on the closing front. In the middle of the month, I'll take it.
Yeah, absolutely.
Good numbers. Cobb County, just to hit the other big county in our world, 326 on the active, 99 on the under contract, same kind of story.
Mhm.
187 on the pendings. Actually has come down a little bit. It looks like in Cobb County, which I think is an inventory thing.
Right.
But closings are way up, 176. So maybe we're just selling it all out in Cobb County.
Good.
Any perspective around these numbers?
I mean, I think the consistent thing I'm seeing is that seasonality is back, right? Slower in the winter. As we hit March, it gets busier. So I feel like it's gearing up to be a more normal spring than the last 2 years have been.
Yep. All right. So, Mark, is the world falling apart?
I do not believe it is. So I was thinking about this a lot, and what's different right now, there's a whole article I can show you about the 5 things that are different about this than 2008. But the biggest thing I can think of is we didn't have social media like we do today. It was just in its infancy in 2008 when everything was collapsing. So you had to pick up a newspaper or watch the TV news to understand what was happening. Now, that still happens, but not necessarily as fast. Now on a Sunday, news can spread like wildfire, and a bank can be shut down. And by this morning, there were 3.
Yeah. So what's that mean?
I mean, I think those kinds of things always go to consumer confidence, right? Like the consumers and those particular banks, because they're highly specialized industries. One was a lot of startups and tech. The other one's like also very specialized. So I think that those industries, the people that had their money in those banks were afraid that they wouldn't be able to insure their money because they had more than $250,000 in those accounts. So they started pulling their money out, and the banks ran out of cash. They couldn't fund it all. So
yeah. So let me do my best to create a explanation around this.
Mm-hmm.
So here's banking 101. So Mark, if I deposit $100 million into your bank,
right,
your bank is not required to keep my $100 million in a vault in gold or cash.
Correct.
But your bank is required to keep, I'm going to use 20% as the analogy today.
Right. They call it a fractional reserve system.
Yeah. So you have to keep a percentage of the money I deposit with you in the bank, but then you have the opportunity to take that other 80% and go make money on it.
Right.
What do you do with your bank? You lend it on mortgages. You'll lend it to small businesses.
Right.
You lend it to bonds, whatever you choose as a bank, which is a private business, by the way. You get to go take that percentage of money and lend it out there into the market and make an interest on that money. Right. So, but if I decide today that I want to remove my $100 million from you, you're playing the float with everybody else's money to give me my money back.
Right.
Well, what happens is your bank lent money on cryptocurrencies. Your bank lent money on venture capitalists that were funding, property technology companies. Your bank lent money on mortgages that went belly up. Right. So all of a sudden your bank gets in trouble.
Right.
And your balance sheet starts to look a little weird. Well, then the news comes out, and Brett Caldwell, the consumer, goes, "Uh-oh, I better go get my money out of Mark's bank."
Yep.
So I run to the bank on Friday and I try to pull all my money out of the bank, and me and hundreds of my other friends are doing the same thing, i.e. your bank collapses.
Yeah.
Because you had some bad investment inside of that. And the economy turned on you too, in the middle of probably some of your investments, right?
Well, and I guess what I read was that they had to pull money out of bonds that they had invested to handle that cash flow need in the short term. And by doing so, they had to realize a massive loss because they pulled them out prior to their maturity.
Yep. So basically bad practice, right?
Right.
So now here's the good news. So most people don't even realize it when they walk into a bank. There's a little sticker on the window that says this bank is insured by the FDIC.
Yep.
And what that sticker means is if I have $100 million in your bank, Mark,
Mm-hmm.
250,000 of that is actually insured by the government.
Right.
So I have a potential of losing everything over $250,000 in your
Right.
bank. Now I'm going to tell you, we've got businesses with more than $250,000 in banks.
Yeah, it's very common.
It's not uncommon because you're not going to sit on that cash.
Right.
So it's only insured to a point.
Right.
Now, the good news is, so that's kind of the banking 101. And in theory, that's how it collapsed, right? So the bank was Silicon Valley, uh, SV, I forget what the P
SVB.
Yeah, Biba.
Silicon Valley Bank.
You can go online and see it.
Yep.
And they had lent a bunch of money on technology companies. Obviously, it's centered in Silicon Valley, which is where a lot of property technology companies were based. So Airbnbs, the Open Doors, the Ojos, there was probably some of their money in these banks. What does that mean for our industry? So what happened over the weekend was this bank got taken over on Friday by the government.
Right.
And then the government did something really smart. They went and auctioned off all the assets of this bank over the weekend before the market opened on Monday morning.
Right.
So now the loss is actually minimized. So there wasn't a lot of black eyes on people Monday morning when they were opening their financial statements to their companies, because we were minimized as best as possible. All that to say, is the banking industry collapsing?
No.
I think there's some banks that are real skinny in their economics because of the practice of where they had lent their money.
Right.
I mean, you look at it, what valuations of companies has gone all over the place in the last 12 months. So if you were lending money on a value 12 months ago and the value went down, the value of that money is much lower today than it was when you actually lent the money. So I want to stop, Mark, before we get into what this means. And are there any questions around what happened? I'm happy to take any open questions here. We did so good at explaining it, Mark. Nobody
did a great job.
Did you say 3 banks that happened to, or just one?
A third bank has been closed.
Yeah.
Yep.
There'll be some more.
Yeah.
But these are not it's probably not where your checking account is. And as long as you have less than 250,000 in the bank and you're with a bank that's insured by the government, life's good, right? And Megan put his FDIC per account. I do believe so.
Yeah, it's per account holder, I believe. So, if Brad, if you and your wife are on 2 accounts, then it would count for both of you. So you'd have $500,000 in that bank protected.
Yep. There you go. That answer your question, Megan? All right. So let's jump to a couple other articles to kind of take this conversation further, Mark.
Yep.
So as I said, the FDIC auctioned off the SVB assets, which I actually took to be a really good thing because they minimized the effect. And then in the middle of all this little report came out, and basically the U.S. Bureau of Labor Statistics puts out a job report, and it talks about wages and employment. And there was a lot of nervous energy around this report because they thought the report was going to come in bad, and then the Fed was going to crank interest rates till all the way through to the summer. However, it actually came in good. And the latest job numbers take pressures off wages and mortgage rates. So we've got two things working in our favor here. One is the job report from the U.S. Bureau of Labor Statistics came in favor of the U.S. economy, which turned out to be a good thing for our industry. And then you've got this Goldman Sachs economist is no longer expecting March rate hike in wake of Silicon Valley Bank collapse. So here's the pro and the con, Mark, that I'm going to throw out there.
Okay.
I think I'll start with the con. I actually think we've got a little bit of a fragile economy.
Sure.
And if you got banks that are failing, that goes to say that the margins are probably a little thin out there in the financial world. And I'm not saying we're collapsing, but we certainly are fragile, is what I would say.
Well, there are a lot of unrealized gains out there too, or unrealized losses rather.
Yeah. However, I actually think this bank collapse saved our spring real estate market.
It's because raising rates in the short term for sure.
100%. I think the Federal Reserve was going to crank interest rates all the way through to the summer, which was going to drive mortgage rates high sevens and would just really, really put pressure on lowering demand.
Right.
However, things changed overnight. And now we had this bank collapse, or two or three banks collapsing, and the job report came in favor. So now the federal government is actually going to keep the rates low, and they've gone lower. If I pull up the 10-year Treasury note, and this morning it was 3.48, and right now it's 3.5. This is the most correlation to mortgage rates that we have, or the best correlation to mortgage rates we have. So Mark, if you remember late January, early February, what were interest rates?
Late February, early January, they're in the sevens?
I would have probably guessed mid sixes, late January, early February.
Okay.
Well, look, the 10-year Treasury, late January, early February, was right around 3.5. Then it went up to 4. And that's when we started seeing those sevens kind of popping out into the marketplace over the last little bit. Well, now all of a sudden, we just took a big spike from 3.9 on March 8th down to 3.5 today. So the correlation is that interest rates should come down. Now, do they always follow this? Not exact, but we're expecting interest rates to actually work in our favor. Right. And this is why I think it's actually going to save the spring selling season. Barring a bunch of banks not having some kind of crazy financial collapse, we actually should get better interest rates, good lending practices, and what's the most stable investment a bank can make these days? It's probably real estate more than business.
Right.
So that's kind of my take on it. The only other thing I'd throw at this, Mark, is Silicon Valley Bank latest, stock steady after emergency plan, Bitcoin rises. We're not going there today.
Right.
But basically, the stock market tells the emotional state of the U.S. economy.
Right.
So if the stock market stabilizes, it actually says the U.S. economy feels like it's still stable. Does that make sense?
Yeah, absolutely.
I'm going to pull the screen down for a minute. And I feel like we've been talking a lot, and I want to make sure I'm communicating clear, because it's kind of a big topic, right?
Yeah, I just put a link in there too for a different article that Emin just put out that says it's about how to talk to your clients about Silicon Valley Bank. And it's a really great article. It's an opinion piece, so it's not factual from a, it's not reporting hard news. It's an opinion, but it has a list of 5 things in there, 5 points that you should mention. And the first one, talks about 2008, virtually across the board, experts are confident the end of SVB and Signature Bank don't spell a major meltdown for the banking industry. Because the banking industry in 2008, the whole industry was propped up and built on a shaky foundation of mortgage-backed securities that were basically garbage, right? The people were not qualified to get those loans. And so those were going to collapse and they couldn't support the industry. So this time you might have a bank or two here and there that don't have a solid foundation because they invested poorly and didn't keep enough reserves, but it's not the entire industry, right? Yeah. And the too big to fail banks are not part of this. So your Wells Fargo's and your Bank of America's, that's where the biggest share of money is in those giant banks, and they're not having the same issue. In fact, they recently passed a stress test. So,
yeah. I mean, you think about it, I'll just give you an example, Mark. How much money did Open Door lose in the fourth quarter?
I can't remember the number. It was a lot.
It's got a big billion something on the back of it, right?
Yeah.
You realize if I'm the bank that's funded in that company and they're losing that kind of money, my investment's not very secure.
Right.
Right.
I believe it was 964 million.
There you go.
There you go. So
a lot of money.
and they're leveraged with this bank, just saying.
Right. Yep. And then the second thing is the financial stress test that the Fed just went through said that the major banks will be able to survive a deep recession and significant unemployment, neither of which is expected to happen, but they're foundationally much stronger than they were in 2008. Number three is these were highly specialized banks investing in cryptocurrency and serving venture capital markets. So not your typical diversified bank, because banks are pretty conservative when it comes to that stuff and tend to be pretty well diversified. Number four, some existing mortgages may change hands. Like that's just going to happen when you have big banks that have mortgages on their books. They're probably going to change where those banks sit because they're selling the assets. And then the last thing is, unless they work for one of the institutions involved, the end of these banks shouldn't cause people to their plans.
Nope.
So, I mean, I do think there's a difference between having a foundation that's bad and having a bank or two that's bad.
Yeah.
Mark
The funny thing, Mark, had anybody heard of this bank before Friday?
People in Silicon Valley.
Yeah. So obviously you can imagine the influence outside of California is not very large, right?
Right.
However, I do think there's some bigger banks that we're probably going to see some banks that have some issues, but
Richard, were you going to say something?
Yes. As far as like the venture capital firms and a lot of the institutions that have bought here in Atlanta, at what point of their margins being thin or just exposure would they look to release some of those assets back into the marketplace?
Look at you looking for silver linings.
Well, so let me answer that two ways. One is I can tell you that I just talked to an agent this morning that's in talks with a hedge fund that's about to unload 6,000 homes in our market. So that's, to me, is a good news. I think that has more to do with the companies, the hedge funds realizing they've already seen the biggest gain they're going to have in the next couple of years. So they're, pulling some money out to take the win. But the other thing is, I think, the investments in the startups and all of that stuff, I think they're more likely to hold those investments because they're not as paying off like they should. So they want to wait and see if they get better. They don't want to get rid of them now. The worst thing they could do is get rid of a bunch of non-performing assets right now and take a big loss, because then they'd have to shore up that loss with cash. So I think they're going to hold on to those investments, but I do think you'll see some inventory be released. But again, I think that has more to do with we've already hit the top of the market for a while, and those hedge fund investors are saying, hey, we did really, really well with these. Let's take our money and run.
Yep. They're certainly pulling out of our market a little bit.
Yep.
Thank you.
Mark, I want to bring one more conversation to the table that was kind of hot to trot on Inman this week.
Yeah.
is an economist teaches you how to answer the rent versus own question. And I was thinking, as the spring selling season is here, I think this is one of the most fundamental conversations every real estate agent needs to have in their back pocket.
Yep. Agreed.
And how do you consult somebody around the value of owning a house versus renting? And what data backed information do you have? So
Right.
if you get a copy of this article, it's on Inman. Obviously, the ROI of home ownership, the wealth building potential, the tax savings, all those things, your net worth impact. Gary brought at Family Reunion this slide. And this is actually under national statistics on the realestatestats.com. And it's actually the effect of rent versus own. And
Right.
in the short run, if you had rented a house and invested your money, you actually did better than owning a house in 2012. And then if you rented a house and only invested 10% of your median income, you did better. But what happens is by year 3, and we just did a comparison over a 10-year period here. By year 3, you're way ahead of somebody renting a house, or somebody renting a house and trying to do some investment. But then by year 10, you're not even in the same game as far as like wealth accumulation. So the point I'm trying to make is not specifically learn just the whole conversation today, but I think this is something, maybe a team meeting, a mastermind topic, making sure this is one of those conversations. Mark, what would you say?
You're on mute, Mark.
You're muted, Mark.
Well, darn. All right. So I was just going to say, even if you take the last 3 years off of there, even in 2019, if you look after 8 years, $121,000 owning, and then renting and investing, you'd be at 79,000, and obviously less if you only invested 10%. So even in an 8-year period, it's still a massive gain over renting, right? So I think that's huge. The other thing I was going to say is FMLS has the financial calculators. If you go on FMLS and you go to finance and you go to calculators, you'll see a should I rent or should I buy calculator. And if you fill that out.
Where are you telling me to go?
Oh, go to products, go to matrix.
Okay.
You're good. And then at the top there, see finance.
Mm-hmm.
And then go to calculators. And then on the first section, you have about halfway down, you'll see should I rent or buy?
Boom.
So let's walk through an example there real quick, Brett. And it's a lot smaller for me, so I'll let you walk through and read it.
So monthly rent, probably $3,500.
Okay.
Renter's insurance, how much will I rent and keeps each year? 3% versus buying a home for $425.
Mm-hmm.
I'm only going to put 5% down.
Okay.
And I certainly am not going to get a 5% interest rate. Let's just go 7.
Yep.
30-year, 1 point closing cost, property taxes, monthly maintenance, homeowner's insurance, tax rate.
Brett, can you change that closing cost? I think it had it at $1,500. Yeah.
What do you think it should be?
2.5%, something like that.
Well, I'm paying 1% here.
Oh, okay. Well, I mean, they're still.
All right, we'll do another 1.5%.
Yeah, say like 6. Yeah, there you go. Percent.
All right. So then real estate commission, closing costs for selling.
So, and the average person, if you go back up there, Brett, where it says how long will you stay there? You can change that to the average person in Atlanta stays in their home between 7 and 10 years right now.
Let's go 8. So if you buy, you can save $173,000 over the next 8 years.
Right. And if you scroll down, you see the calculator results detail.
Yep.
Click that up a little higher. There you go. So this is going to walk you through those numbers. So side by side, the rent payment versus the purchase payment. So this is a really powerful tool to use with a buyer that is renting right now and is thinking about buying, or that's saying, you know, I'm just going to rent for another couple of years.
Yeah. There you go.
I mean, if you can show someone that over the next 7 years, they're going to lose $171,000 if they don't make a purchase right now, all of a sudden 7% interest rate doesn't seem like such a big deal.
Yeah. On this analogy, it's about 2 years where you break even on rent versus buy, and then it
Yep.
exponentially takes off.
And that's typically the case because of the closing costs involved. Even with refinances, it's typically 2 years before it makes sense to have refinanced.
There you go. So we got some good thumbs up. I realized it was a short conversation. Your team leaders certainly can have this conversation with you. I'm happy to take any phone call if you have questions about the SVB. But honestly, my big message around it is I wouldn't shy away from saying that the economy might be slightly fragile. Yet I actually think it's going to turn out to be a really good thing for the real estate market over the next 3 to 6 months. So there you go.
All right.
Have a good one. Thanks, Mark.
Thanks, Brett. See y'all.